Anu connected for me? Great. Anu, thanks for being here while we get set up. And great to see you.
You as well. So excited to talk about our latest paper, The Liquidity
Yeah,
Landscape
you guys did a really,
2024.
really good paper that puts this into perspective. You're the head of U.S. Index Investment
That's
Strategy
correct.
at S&P. And we also just found out that
It's a blast from the past. So it's so nice to see you and to talk derivatives, to talk the index ecosystem. You're right. We have lots of numbers, and happy to give you a few stats, and we can run through it.
$200 trillion and the increase in index equivalent trading volume for S&P Dow Jones Index Link volumes was up 20%, which is a
Right.
cool 50 trillion
Right.
year over year. Is that right?
That's exactly right. Roughly $296 trillion tracking the products, tracking our indices at S&P DJI. A big chunk of that comes from the S&P 500. Their growth was roughly 50 trillion. If you look at just the S&P 500 alone, that's 273 trillion dollars in products tied to the S&P 500. Plus, if you tie products derived from the S&P 500, like sectors and factors, that gets you to $279 trillion. And what this really shows are the network effects of liquidity. If you think back to 40, 50 years ago, if we were sitting here, it would have been a very different story, right? And now the key benefits are really price discovery, confidence in prices for both passive and active investors, and overall market efficiency. So these are really the key benefits of liquidity for the index ecosystem.
So it's kind of like some of the network effects, almost like liquidity drops, more liquidity. You want to go to the most liquid places. You want to go where you're going to have the easiest, movement,
Right.
smoothest, transactions. That's going to happen in the deeper pools. Is there a particular theme in terms of the year of past that 50 trillion of growth,
Right.
where that came from, either sector or style wise?
Sure.
Is there a bias in that growth?
Sure. I mean, you hit one of them, which is sectors, right? Increased growth in sector and industry future volumes. If you think about top down asset allocation, more granular exposures to add to your sector toolkit, or industries being more tactical or for diversification purposes. Also, it's not just equities. We have a huge growing fixed income landscape as well, which is very exciting to see that in the indices space. The other point I'd like to hone in on is a lot of times people tend to think that long-term passive investors are kind of set it and forget it,
Mhm.
right? But this really applies to both passive and active investors. And what we did is we actually looked at the holding periods of these investors. And what we found is a lot of them are highly active,
Mm.
but trading passive products.
Mhm.
And the median holding period actually came down, which really shows you the benefits for both active investors as well as inactive investors. And the word I like to use is harmonics. People are trading these index linked products at different frequencies.
Right.
And the continuum, active versus passive, continues to blur.
So that's interesting that it's getting more active. And in the last year, index-based products make up almost 1/3 of the most traded securities.
Right.
And I think also too, to your point, we have these kind of main benchmarks that people think about, but everything else that's built around that kind of goes in line with a lot of the derivative conversations we've had. New products getting launched,
Right.
active traders. Last week, the retail kind of summit at Robinhood's conference. You've got a lot of that participation now.
Yeah.
And I think that too kind of almost forces the hand on, we've talked about a lot about advisors on the show where they kind of are forced to start to engage with options. So all that kind of adds
Hmm.
on to
Yeah.
those index linked products.
Right.
And then the core that people have a lot is just in that kind of passive stock market index too.
Right, and it's global. I mean, we're sitting here in Germany, and you can trade the S&P 500 all around the world, which is a pretty powerful message, and really offers that price discovery. Because again, 40, 50 years ago, if you had to wait till the exchange opened, right, to find out how your products were doing, and now you have the price discovery with futures, for example. We also have options, ETP options. It continues to grow. The story is global, and really these connections, these network connections of risk transference, arbitrageurs, pricing things, and reducing those inefficiencies can really help. And just the robustness of the ecosystem continues to grow.
They're all doing different things, but at the same watering hole, basically.
Right. And like I said, it's really a continuum all the way from the long-term passive investor, right, tracking the S&P 500. And like I said, there's price discovery. Indexing also contributes to market efficiency. And
Mm-hmm.
also there's the confidence factor to know that the product is tracking the index, the S&P 500, and that the index is fulfilling its objective of tracking large cap stocks in the U.S. Market. So this increased scrutiny, increased confidence, all really helps together to just bring it together.
I love it because you kind of hear a lot of times this, you do kind of get this chorus of negativity with the amount of people that are trading, the amount of household wealth that's tied to equities. And you hear a lot of kind of the negative crowd that say, oh, this is unsustainable. Not everybody, I think it is quite the opposite. In fact, when you have more engagement, to your point, transparency, efficiency, volumes, confidence, I mean,
Right.
as the ecosystem grows, it becomes more healthy, which is why we call it like an ecosystem.
Right.
That's the way it want participation.
That's exactly right. And there's so many different nodes. We've talked about sectors. There's also factor exposures. There's dividends. There's sustainability. These are also products derived from the S&P 500. There's also risk. Think about VIX-related products. So it continues to grow, which is pretty exciting all around the world, where we're tracking it from here all the way to Asia and Australia and so forth.
And here we are in Germany for it. $50 trillion growth in volumes of products tied to S&P Dow Jones indices in 2024 to almost 300 trillion. I mean, great numbers.
Thank you so much.
Absolutely. A great start to the show, giving us the holistic look, basically, and the massive size behind it that makes it more efficient. Let's go into the intraday. Let's try Brent one more time. Really want to get his take. Market. Maybe we go from grind mode into like launch mode. Brent, is it possible zombies could go from walking to run?
Hey, Oliver, how you doing? The market's up 5%, 2% over the last week, which turned out to be an annualized vol. If you annualize that, that's around 14.5% implied vol. Now, the interesting thing about that is when you look at what the market has been pricing in over the last week, the annualized vol on that is closer to about 13%. So while we have been in this view of grind mode, the market is realizing more vol than what has been priced in. And that is a really interesting dynamic because we're turning into, number one, VIX expiration tomorrow. So today is the last day that VIX, September VIX options can trade because those all expire tomorrow at 9:30 a.m. Eastern. And then we have FOMC. And the reason I bring that up is because we're going to clear out a whole bunch of VIX positions. Essentially today, there's going to be a lot of rolling and trading. That is a destabilizer to me in the market because there's been these forces that have been pressuring short-dated implied vols in particular. So just to reset this conversation real quick is if we're up 2% in the last week, that's a 14% implied vol. Market's pricing in about 13. And then we have Powell, right? And Powell could be bullish or bearish. Obviously, if Powell just whispers one incorrect word, there's plenty of room for downside here because no one is pricing in downside. So vol should expand here. I think that is the key statement. Now, that could express to the upside. That could, of course, express to the downside. That's a little bit in the way that markets take Powell's sentiment. The other thing I want to add is the 0 DTE implied vol has been as low as it gets. Yesterday, we saw roughly an 8% implied vol. Market was pricing in on a 0 DTE basis about 28 bips of movement. That is exactly the same thing today. We have retail sales at 8:30, and the market just does not care. If you're pricing in 28 bips of movement based on the 0 DTE straddle, that is literally as low as it gets. I mean, you got to go back to, you got to go back maybe a year to get a similar price. So the market is as complacent as you can be on an intraday basis right now. And I think just really underpricing any type of move outside of FOMC, which is tomorrow. So again, the VIX positions expiring could be the initial destabilizer here to start to shake things up. Obviously, if FOMC, the market's going to wait a bunch on that, but things are really primed to move here. We're favoring the downside a little bit because of how low implied vol is. The last dynamic I want to add into this is we still have that JP Morgan collar position, which we haven't mentioned much here the last couple of days. That's at 65.05, right? Which is now 2 to 3%, incredibly, from where we're sitting at the moment. I guess a little bit closer to 2%. So any spook in the market or a little scare, right? You could immediately move, or just a base correction. I mean, we're up so much, right? you immediately move down to that strike, which expires at the end of the month. So, we don't have to have this epic crash from this, this space. We're very stretched to the upside. And, I think when you look at the way that the market's pricing things, a correction here would totally be in the cards. It doesn't necessarily have to be a bigger crash, but at the same time, if Powell just upsets the market a little bit because everyone is just so unified in their vision, that's where you can get a pretty shocking move to the downside.
So we just got a little bit kind of frothy in the last week, and that's an important point, I think, because when we've been describing this as this steady one step forward, very slowly grind, it becomes something different once we pick up a little momentum the way we have. Brent, I'm looking at Trace right now. What should we be looking for in terms of either the JP Morgan collar trade that you talked about or anything else in here that might tell us, okay, because if you're saying, look, it looks like vol maybe could pick up and we get priced to the downside. Well, what if we get what if the vol picks up and we get stocks up too? What if we get one of those moments, that kind of, 1 out of 5 times where you get vol up, stocks up? Could we be getting that if we break through some of these major areas that market makers and big institutions are maybe positioning against?
Yeah, absolutely. And, we try to get both sides here. And so we could, of course, have a dovish Powell that the market just loves. And even on that point, to the point of underpricing vol, you look at 1 month options, you look at November or DEES, like 25 delta options, they're trading at like a 10% implied vol, 11% implied vol, extremely cheap. So even if you say, hey, I'm a bear, I want to bet on downside, you can buy that upside call protection quite easily, right? Or if you're a bull, go ahead and buy some of that put protection, right? You could go either way because these options are just so cheap. So to me, it's a great time to get long options. We're favoring that downside mainly because the market is so stretched to the upside. Consensus has been, one-sided here that the cuts are going to be helpful. We're up 2%, like I mentioned in the last week. So we don't want to say, hey, we're bullish or we're bearish here on some macro call. It's just that things are very stretched. But to your point, optionality is extremely cheap to the upside or downside. So there's fantastic structures either way. Now, when you look at today, the implied vol is very, very cheap, as I mentioned, 28 bips, which is literally as low as it gets. You have a huge strike there for 0DT at 66.75. That's what that giant purple bar is. So intraday, you're seeing there's that big strike. And then to the downside, there's decent positions into 6,600. If we break 6,600 at any point kind of today and tomorrow, that's the sign that the bears are really starting to get that, leverage, that things are really starting to shift, the equilibrium starting to shift. So we keep rolling up this risk off level. We're really watching that 6,600 price area as the kind of alert, right? The alert triggers under that 6,600 level. Now, one other thing, we've been talking about how massive the 0DTE volumes have been.
Yeah.
We just had record 0DTE volumes about 2 weeks ago here on a daily basis. They're just huge. And that is a function of the low volatility regime that we're in, right? As short dated vol comes in, meaning, 1, 2, 3 days to expiration vol keeps getting contracted. Those 0DTE strategies gain in size, right? The volume gains in size. And the tricky part of that is that's a stabilizer for everybody on an intraday basis. But if risk flares a little bit, if Powell is like, hey, I'm not going to be as dovish as everybody wants, then that 0DTE stabilizer tends to disappear. And in this market, so much of the liquidity right now is in that 0DTE space. If you lose that liquidity, it is a real risk, right? Because you lose that liquidity and then things can get a lot jumpier. And so I think that's a really critical thing that people want to understand right now is that, yeah, we're getting 65% 0DTE at the moment, but if Powell's like, hey guys, tough luck on these huge rate cuts, then all of a sudden that 0DTE volume can drop. And that's a major dynamic. We saw that happen during brief risk off spats over the last couple of months. So again, there's a lot of reasons to think that the stabilizing force with VIX expiration, these 0DTE dynamics, kind of reset here today into tomorrow with VIX expiration, and then a massive options expiration on Friday.
I like your point about watching the 0DTEs to see if that kind of supportive nature fades whatsoever, given that it has been pretty supportive. Brent, is there somewhere we can see the levels on your platform? Where should I go here to get that perspective on the 0DTEs right now versus last week or so?
Yeah, if you go over to the indices page there.
Where am I looking? Left side?
It's left side. It looks like a bar chart.
Okay. Yeah. Hero or volatility dashboard?
You're going to go about 5 or 6 buttons down, and then you go over to the open interest tab.
Okay. Open interest.
Yeah, and then that chart right there, if you just on the left x-axis, excuse me, you can drag that date slider into over about
Okay,
the
yeah.
last 12 months. So
Bring it in a
drag
little
that to the
tighter.
left.
Oh wow, yeah. So is the purple here showing 0DTE?
That's right. So that top right, you can see how we've been hitting almost near 67% in that purple, right? And that's been the big 0DTE volumes we've been talking about. The last couple of days here, they're starting to contract just a tiny bit at 58%. But this can go down into the 30s or 40s. That's what we saw in April when things really got nasty, right? And so, this is the stabilizing dynamic that could essentially kind of be removed or recede a little bit in this market. Now, there's these other signs too. I mean, if you look at Elon buying stock and he's starting to talk about his stock positions and stuff, that's all classic kind of meme mania markets at the same time. So it's a real interesting convergence here. That stock was just up, so massively yesterday. It looks like it's up again here, kind of pre-market. So, there are a lot of these frothy indications of kind of just excessive bullishness as well. And you have to keep you have to have new positive sentiment injected into the market to sort of sustain a little bit.
That's cut.
Traders are a bit over their skis is what it feels like maybe.
Okay, great stuff. Love that chart of the 0DTEs showing how much that's contributing over the last couple weeks here. So we'll be watching to see if any of that slows down, if any of that supportive flow subsides. Great stuff, Brent Kochuba. Thank you, sir.
Thanks, Oliver.
Nice work. Spot Gamma. Thanks for sticking around for us. We're getting close to the open here, 118 in Munich. Let's talk some options and let's talk some crypto too. A lot of things on the mind of Mr. Derek Devins joining us from Neuberger Berman, Senior Portfolio Manager and Portfolio Manager of Options Strategy. Great to see you, Derek.
Thank you for having me. Yeah, great to be here.
We were just talking about the explosion of 0DTEs. It's been a subject, obviously, over the last several weeks here, comprising like 70% of volume on some days. Are you in that market?
No, we don't do the 0DTEs.
Okay.
That's a little too short dated for us. So when we think about our institutions and some of our goals, whether it's income or hedging or just lower volatility, it hasn't been a space. So I'm hugely supportive of it. It's great for the market in general.
Okay.
But we don't dabble.
You don't like to watch things immediately decay after you.
It's tempting. It's tempting. I think it more of when I think of the dealers out there and a lot of people looking, one of the challenges historically was always hedging your gamma. Well, when you have that type of flow intraday, it really opens up a lot of books. So we get more liquidity, more flow, which is great for institutions and where we traffic. So it's really an ecosystem that's become more balanced, not less.
Tell me about the strategies that you spend most of your time in right now. I know you've got an ETF that's options based.
Yes.
You've also got a private crypto based fund. So maybe let's, since we're kind of talking the general, let's start with the ETF and let's talk about kind of the accessible for anybody that wants options strategy. What's the goal for that?
Yeah, we're like every, kind of strategy in the space in options is really divided between either directional trading or income. And this is on the income side. So we're in the put right space to be a little more specific as opposed to the collars or the hedge strategies. So we're looking to take short-term rates and add income on top of it through index options.
Okay.
So pretty general strategy, but we think it's pretty time tested.
If I'm an advisor and I don't have an options sort of strategy for my clients, is this something I can layer in? Because I feel like that's kind of a starting point for a lot of these advisors, just generating basic income.
Yeah,
strategy.
Absolutely. When you think about the two mainstays, which are kind of covered call strategies,
right,
or the long, this is kind of the other half of that. So when covered calls and stuff are, maybe selling away a little bit too much of the upside, as you were talking earlier. What if we get, vol up, stocks up type of situations?
Right.
So we're on the other half of that equation. So we'd absolutely recommend you kind of layered in, diversifying your income, but also do it more as well from collecting put premiums as well as call premiums.
Using spreads, or is there any time where vols, so you just sell an and you say, look, that's
so we systematically risk manage. So it's an interesting concept of, we like spreads, put spreads for certain situations. But we think of a stop loss is just as effective. Why buy the reinsurance when you don't need it most of the time?
Okay, fair enough. Got that. When you look at markets right now, is the vol too low for the things that are at stake, or are we going back to like a 2017 like 11 VIX mode?
It's a great question. I hope, but I don't think we're going back to 2017. I think the analogies right now are more just a product of, there's very few times that you get an easing cycle with a relatively strong economy. So, putting my macro hat on, I think stagflation is more in the equation than it was a year ago.
Okay. But
Despite
then bonds are pretty chill. So if that's the main threat and bonds aren't too worried, then I guess you're free to take risk.
Yeah. So, and we still live in a world where, lower vol and the momentum is kicking in. Stocks, particularly the S&P, is largely the only game in town.
Yeah.
Right. When you think about, even if you're a global investor, it has any opportunity, you're buying the S&P.
Okay.
Right? Risk on is buy the S&P.
Or something attached to it, as we heard from Anu Ganti at S&P, $50 trillion of volume growth in the, everything attached into the ecosystem,
Yes.
into the index world. So, all right, let's talk some crypto then.
All right.
What are you doing with crypto, and what is the kind of client base you're trying to target here? Because obviously Neuberger Berman, I think about having as a very sort of institutional general appeal. What do they want from crypto, and how are you using it?
Yeah, so 5 years ago, believe it or not, we tried to bring it more into the institutional space. So when you think about using derivatives markets, for most of my career and everybody else's, you think of derivatives being the next layer. Well, in crypto, it was actually a very secure layer, because you get central clearing, you get a lot of things that didn't exist in the, what you call the DeFi world.
Swamps.
Yeah, exactly. Good. So now we tried to move that more into the institutional space. Launched a fund, have had some success with institutions, and now with the ETF options on Ethereum, Solana, Bitcoin, it's really a robust environment to take some of that exogenous risk or that counterparty risk, the liquidity, and you still hold your tokens, but you have more options, pun intended.
Yeah, you use options on crypto. So when you think about crypto, a lot of times in kind of the just general investing world, crypto is related. You're in it for direction you're in it for upside. You're in it for price action. Is that a goal here, or do you want to take that kind of volatility and reap income from it similarly to how you do in equities, or do you want to be on the price ride for crypto?
I hate to have a foot in both canoes, but we want a little bit of both.
Okay.
So we're not a true market neutral. So when I think about the crypto in the DeFi world, tries to trade a lot of rel val, right? You're looking at maybe some of the fringe tokens and trying to trade relative value. We wanted to also be a little bit more defensive and hedge. So I think of it more of like a hedge fund with a coupon.
Okay.
Right. So you think about liquid alternatives, you think about other things. You can just go buy Bitcoin or be directional, which is one strategy. So we're trying to, I think, be more a little bit in the alt space, but not a market neutral. It's so volatile. Being market neutral kind of defeats the point.
Right. Now, that's kind of okay. So I was debating in my head whether or not to ask this philosophical question, but I will, since you mentioned that. What do you think happens if Bitcoin calms down? Because one of the things that's been really interesting is obviously Ethereum had this great outperformance in the last several months, where Bitcoin had this great run, but then keeps kind of grinding around this 120-ish. If I take a line from momentum, which I look at RSI a lot, even as Bitcoin made new highs, the RSI went down. It's kind of like it's either maturing, or maybe MicroStrategy stole all of the risk thunder. I don't know, but I'm curious how you think about that. In a world of maybe a calmer Bitcoin, how would that change the way it trades or who it appeals to?
Well, one, I think it favors our type of strategies in the Bitcoin world. And I do think the maturation is coming. I do think Ethereum and Solana and some of the, what I consider more app-based are going to decouple from, not in a bad way decoupling, but just are going to have a little bit lower correlation to Bitcoin. So you've got the maturation of Bitcoin. And then now once AI kind of finishes stealing the spotlight for the last couple of years, you're going to get back to the idea that AI is going to need some of these digital apps and the blockchains to do more. And so then you're going to see a real race for Solana with its speed and cost efficiency versus Ethereum and its broader platform. So I think that heats up as you move away and get Bitcoin to kind of solidify as basically a digital asset. Then you get backfilled with the smart contract platforms. Very fun. Can you give us a little idea right now what the secret sauce is in the fund? Are you leaning into any particular token more than others? I kind of previewed that I've been doing more work, and I like the Solana, faster, cheaper, better. It's going to really compete with Ethereum. So from just a horse race with the big two, I think of it as Microsoft and Apple. Both are going to be winners, but I think Solana kind of is going to close the gap a little bit. Nice. All right. Good stuff. Derek Devins. Fun. All right. Be in touch. Thank you. Nice there. Options, crypto, ETFs, and more.
Derek Devins, Newberger, Berman. We'll be right back, taking a little break, and then we got some Cboe folks. Got two good ones joining us as we continue to talk about what's happening here at the Risk Management Conference in Munich, Germany, Bavaria. Be right back. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak, making billions. And its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. At Cboe's Risk Management Conference. We're getting ready. It's day 1. Some folks woke up early this morning to go race cars and do tours of distilleries, but we're live here early morning in New York and Chicago, getting ready for the opening bell and a big move in stocks at all-time highs. Let's talk about what's on the calendar and the schedule and the itinerary here in Germany. Joining me, Megan Dugan, is the head of options at Cboe. Megan, great to meet you here.
Nice to meet you as well, Oliver.
And head of options at Cboe, that sounds like head of cars at BMW, head of food at McDonald's. You were hired in February, so tell me kind of where your mind's at. Yeah. What's exciting to you, and obviously a lot of people associate what we're talking about here today with options. Our whole show that we've been doing from Cboe is obviously very options heavy. What's exciting to you right now?
Yeah, so much to cover. Thank you very much for having me.
Yeah.
I'm very excited to be. This is my first RMC actually coming in, and this one is very special in general. We're celebrating the 40th sort of anniversary of bringing this entire conference together.
Oh, cool.
And this is a really amazing group of individuals, a very diverse background. You have sophisticated traders, you have the retail side, you have the institutions, the sell side, the ETF issuers.
Yeah. We're just talking crypto.
You have the gamut of sort of curated, sophisticated people that can come around to share really great ideas around where we see this market moving in a short term and sort of a long-term trend perspective. Also, while sharing innovative ideas, what's new, hearing what everybody else is up to, right? And we all hear those pieces to help drive what we all want to drive in our strategy when we go home, right?
Yeah, I keep thinking back to Anu Ganti's numbers from the top of the show from S&P Dow Jones. Index-linked volume growth of 50 trillion. So so many people are parked in the market, but then obviously you have now more and more people trading around that market as well with options and a whole retail side that now institutions, we're talking about the same things, a lot of them here that we were in Robinhood last week.
Absolutely. And we see this across the gamut of the trading window as well. So we offer the global trading hours for index options for S&P and VIX and XSP, and we're actually seeing a lot more growth coming into that space. So to your point of getting access to liquidity to that large market that we have available for the S&P complex, access to the global trading hours from retail brokers and other institutions are really starting to gain a lot more momentum coming into 2025 and definitely into 2026. So we expect to continue to see record growth coming into that space.
As the growth comes in, how do you make sure everything runs smoothly? Where do you spend your most time? You're thinking about this kind of comes back to the Chicago side as well, where we've kind of got this bias of Chicago thinking about the plumbing, market structure. Everybody's going to be taking part in these things. We got to make sure that everything's liquid, prices are good. How challenging does that become as the volumes go up?
So this year, in the March, April sort of macro environment that we saw with the market moving so quickly in the up and down fashion, really stressed the system capabilities across all of the general markets, definitely including ours on the SPX and SPXW complex. We've learned so many great key attributes from that effort and the market moves, so that we, at the core, every day at Cboe, we want to operate resilient, stable markets. To your point, like, we need to make sure that people feel confident and secure in coming to us at any time of day that our markets are open. So we need to ensure that we're constantly evolving our technology, looking at how we're looking at market structure initiatives to help either adjust behavior or add more operational efficiencies. And we can talk a lot about some of those things that what we're looking at and what we're excited about coming in.
I'm curious about that, because what I've, so many people, and I think especially from just sort of the individual, kind of the retail person's view, you kind of view everything, the game is set, the table is set, but it's really not. It's actually changing. Like, we were talking with Jason Hicks from Matrix Executions on the show a couple weeks ago. There's so many little places for people to find and create more alpha. And it seems like as participation grows for options, that ecosystem is becoming, it's getting filled in. It's finding new players and new products and new tech.
Yes, and one great example is at the end of June, we launched a new order type that includes a flex leg as well as a listed leg in one spread transaction. So you could have more than one of each, but basically it's a new construct where it is essentially one transaction handled sort of atomically within our matching engines as one group. So we're excited to have launched that out. And that's been really gaining a lot more momentum from a lot of the flex investors. As it helps fine tune really their operational efficiencies, because they were really doing this in two different ways. They were submitting two separate orders to the exchange to be able to really have the same sort of generated alpha, but now we can do it in one.
That's a great example. And I'd also hear flex options getting used more and more in the lexicon of the derivatives world as well, from institutions, from ETF managers and more. I want to make sure that we talk about your background too, and give some of this context, because you started at Cboe earlier this year in February, right? Or
That's right.
February. And you've got a background that includes algo trading. You were on the floor. I mean, how do you combine what you're doing now, thinking about strategy, but also, the market person inside you? It never dies, right?
Oh, no. Yeah, that's what's great. And also the trading floor is definitely my home away from home. So I love spending time in our Chicago, our floor in Chicago. So yes, so it's really been giving me a wide understanding of how really to look at our strategy overall, having been able to live in those moments in different parts of our financial history, or the market history, to understand moving like the flash crash side and sort of the credit crisis and all moving through. We all learned, our entire markets have learned, right? So we've generated better enhanced risk controls, making the end customer investor much more confident in knowing that they can come in with added protections, but also having the ability to see it from a trading perspective, an institutional perspective, a retail side, and now the exchange perspective. At Cboe, it is the home of derivatives.
You see how all the gears connect, right?
Yeah, so
where it all comes together.
I'm very grateful and very happy to be here. It's been a great 7 months. I can't believe it's already been 7 months. I feel like I've been here forever. So it's been a good, in a good way.
That means it's home. That means it's a natural place. I feel like you've been there forever. Well, the way you talked about the drop in the spring of this year in the market coming back, I can sense that you have that trader still inside you. So we're going to continue the conversation. Great to meet you. Great to have you.
Thank you so much, Oliver.
Absolutely. Megan Dugan, head of U.S. options at Cboe. We're going to talk some bonds. We're going to talk some futures. We got David Litchfield patiently standing by to close us out. We'll be right back from Germany. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago, Future of Finance, live from Munich, Germany, at Cboe's RMC conference. That's Risk Management Conference. We've talked about options. We've talked about crypto. We've talked about data, trillions of dollars being built around the index world. Let's talk some bonds from a bit of a different perspective. Joining me, David Litchfield, who's Director of Derivative Sales at Cboe, based in London. David, great to meet you. Great to see you.
Thank you very much for having me.
We've been talking, I think, just about every asset class yet today, but we haven't hit bonds. But you think about bonds from an interesting perspective, which is through the way clients use iBox futures, which is both high yield and investment grade bond futures. They've been around since 2018. I'll be honest, I'm not as familiar with them as I probably should have been for all the time I think about bonds. But that's because I'm like stuck thinking about what the Fed's going to do. What do you think about?
So it's been an interesting space. Many people in this space only trade OTC. They trade bonds OTC, they trade derivatives OTC, and you introduce something listed to them, and it's completely alien. So we've been through a bit of a process over the last 6 or 7 years of building out the market and getting familiarity. But effectively, they are instruments that a huge swathe of the investing community use and are excited to use.
You came from BlackRock prior. The I in the I box should be a hint that there's a BlackRock partnership in there. So we're using the same underlying indexes for high yield investment grade that BlackRock offers, right?
Similar.
Similar.
So this is where there's a little complication. If you think about, we were to launch another equity index and some futures on that, day one liquidity is almost infinite. You can program trade, have many cash equities, liquidity is easy. You can't trade 1,300 cash bonds,
right? Yeah.
or 2,800 investment grade cash bonds like you can equities. So we had to be very clever with the product design around liquidity. And the way we've done that is link it explicitly with the 2 largest ETFs. So the investment grade future is linked explicitly to LQD.
Yep.
And the high yield future is linked explicitly to HYG.
Got it.
Those bonds that those ETFs hold then form the index that the futures track and settle against.
Okay. Now, do most people use this? Are these institutions that want to hedge out their corporate bond exposure, and they're mostly using these as tools to kind of brush up the portfolio or find, moments if they think the market's going to get volatile? Okay, maybe we'll hedge it with this. Or are people using it like a speculative instrument?
Yeah, everything and all. Like a lot of accounts would use futures. And one of the reasons I get very excited about them is because there are new users being brought into this market that have never been in this market before. So one of the conversations we had with the institutional investors, pensions and insurance, many of them are prohibited from using OTC derivatives. Many of them are not allowed to use ETFs. And so they're sitting on trillions of dollars of corporate credit that they can't effectively hedge. And they can use some govy futures to manage the duration. But you go into them with these futures where they can manage their bond portfolio, and they get very, very excited. And that's trillions of dollars of corporate credit that isn't currently involved in this market. And then all the way down through asset managers, wealth managers, being able to allocate small amounts of futures across multiple portfolios, both on the long side and the short side, and then down into the CTA community is like $350 billion industry that is used to trading futures.
Right.
And now they can trade corporate credit in a futures wrapper.
Interesting. And so they can trade, especially because if you're thinking about bonds, a lot of times you're effectively just trading like a pure duration. If you're going to be, trading treasuries, obviously, is the biggest kind of liquid market for bonds. This gives you a nice way to trade credit speculatively without having to, I guess, do each name of research.
Exactly. You get that index exposure of those cash bonds.
Yeah. What about from, I'm curious, like the individual, the retailer, or the smaller, person who just wants to kind of speculate on the direction of corporates? Is there a market for that, or would people do they generally gravitate towards equity if they want to express a corporate view?
No, I think the ETF has led many more retail investors into the corporate bonds world than otherwise would have been present before.
Okay.
And the futures are, again, another wrapper that they can use. And we do see some real retail activity.
Yeah.
And it's certainly in the high net worth end of things as well. So the denomination size of these futures is around about 150-ish $1,000 notional, but of course with the margin requirements of futures, you're putting down a fraction of that. So we do see retail adoption.
Okay, so you see, and maybe advisors too on behalf of clients, kind of an in between there, higher net worth retail, they're doing something on behalf of. Is there when you have the Fed generally just being quite dovish and cutting, and it seems like so much driven by that, is there still a great utility in trading the credit side of it, or does duration just drive the bus basically right now?
It does, but the futures offer that wrapper in terms of the corporate credit exposure. It's the duration and the spread.
Right.
And you mentioned a good point around the Fed. Corporate credit markets have traditionally been pushed around by buy side versus sell side. The Fed says something, everyone's a buyer. Fed says something else, everyone's a seller. These futures allow what I would call the more democratization of that market. There are many more users in there using them for many more different use cases, and therefore the diversification of that liquidity pool is something that's very exciting.
You came from the options side, not so much like a bond trading side. I am curious though. I mean, I'm sure you're plugged in watching, the bond market. We're expecting cuts here coming up. Do you think that materially changes the trend? Because the corporate bond trend generally looks good. I imagine this is not going to hurt.
Yeah, absolutely. And that movement of the market. So a couple of years ago when the markets were kind of flat and zero interest rates is all a bit boring, when markets become more volatile, that's when investors have to move their portfolios around. It happens in all asset classes. If the S&P is absolutely flat as a pancake, well, there's not that much need to use options and futures to manage portfolios. When markets become a little bit more volatile, that's when those instruments come into their own.
Got it. Great stuff. Love it. Nice. And we're able to bring it full circle to a little Fed discussion ahead of the news this week. David, great to meet you. Good conversation.
Likewise. Thank you for having me.
All right. The iBox futures, IBHY, and IBIG.
For investment grade.
Okay. Great stuff. David Litchfield, Director of Derivative Sales at Cboe. All right. We're nice and warmed up here in Europe. So that means a show tomorrow at the same time. 12:30 p.m. is when we're going to aim to start here tomorrow from Europe. So if you're watching, set your alarm, wake up early in Chicago or New York, or maybe just tune in. You can always watch the replay on X, on YouTube, LinkedIn as well. I'm Oliver Rennick. Thanks for tuning in. Also, tomorrow, going to do a great panel here at RMC for those who are watching, talking about hedging cross-asset risk. That's in the morning at 9:30 here for those that are in town. If you're not here yet, come on through. Conference is great. I'll see you tomorrow. Thanks for tuning in.